Hi there. As you're coming in our webinar room, I'm going to go ahead and welcome everyone and do a little bit of legal housekeeping before we get started. My name is Marche and I'm the webinar director here at Advice Chaser. And here's a little bit about our disclaimer, and then we'll get going. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Attendees are muted, but we encourage you to ask questions using the chat box, and the presenters will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box and we're not able to get to it during today's presentation, go ahead and leave your phone number as well, and we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible. So once again, don't hesitate to chat a question, ask for clarification or expansion of the material. That's what we're here for. Well, I'd love to introduce you to today's panelists. And our moderator today is Michael Hart, the CEO of Hemispheres Investment Management, a global investment management firm he founded in 2014 that manages both equity and balanced account portfolios for individuals. He has over 34 years of capital market experience. From 2007 to 2013, he worked as a managing director at Tradewinds Global Investors, where he was a global equity and emerging market equity portfolio manager and a global securities analyst. Prior to Tradewinds, Michael founded and operated Hemisphere Asset Management from 2000 to 2007, and the firm managed global equity, fixed income, and balanced accounts for individuals and institutions. From 1989 to 2000, he helped manage the investment portfolios of the Farmers Insurance Group of companies as a senior portfolio manager. During this institutional tenure at Farmers, Michael spent 8 years working as a portfolio manager of emerging market debt investments and 4 years as a portfolio manager of international equities. He helped increase the value of the insurer's international investments to over 1.1 billion from approximately 50 million. He's also received awards of merit for generating outstanding returns as a portfolio manager of foreign fixed income and equity investments. So Michael, go ahead and say hello so people can see your face, and Michael will be monitoring the chat today.
Thank you, Marche, for that wonderful introduction, and I look forward to facilitating this presentation.
Very good. Thank you so much. Well, we're very pleased to have our guest speaker today, Rebecca Holden, who has over 30 years of capital market experience. From 2003 to 2010, Rebecca was portfolio manager and principal at Archer Capital Management in Los Angeles, California, where Michael is. And she was managing domestic equity portfolios for individual clients. Prior to working for Archer, Rebecca was an equity analyst employed by Lehman Brothers in New York City, following electric and gas utilities, as well as energy companies. Before relocating to NYC, Rebecca was employed as an intermediate portfolio manager for the Farmers Insurance Group of companies as one of 4 corporate portfolio managers. Rebecca was employed with prominent West Coast financial institutions prior to employment on the Farmers accounts. And Rebecca held positions as a credit analyst, banker structuring both private and publicly held bond issuances, and later manager of one of the largest groups at the bank. In addition to the professional designations held, Rebecca has an MBA from Brigham Young University with a double emphasis in quantitative analysis and finance investments. And Rebecca's coming to us from beautiful Colorado. And we're so excited to have you here to present. And I'm going to let you take it away, Rebecca.
Thank you, Marche, and thank you for that introduction. I appreciate it. And I want to thank each of you for attending this webinar today. We will be discussing transitioning from an employer-sponsored retirement plan to a self-directed IRA. And this is such an important topic because doing it wrong can have profound and negative consequences. At the beginning of each presentation, we need to advise you that every situation is unique and you should consult a financial advisor to get a customized plan for yourself before making any changes to your retirement account. Retirement plans were established by the IRS, and there are very specific rules that govern the transitioning of these assets out of an employer-sponsored plan. And it's important to know and follow the rules to avoid a taxable event. Okay, there are various types of retirement plans, and each type is determined by your employer. The rollover and distribution rules vary depending on the type of plan that you have. And in this chart, I have started out with a column that says qualified plans versus non-qualified. And this has reference to Title I of ERISA. And ERISA stands for Employee Retirement Income Security Act of 1974. And this has to do with the rules of the plan, such as vesting, employee participation rates in the plan, non-discrimination contribution percentages. What that means is if a employer has an amount of money that they want to allocate to pensions in a specific year, there are rules how that can be allocated. They can't have like all of it going to a few key employees. There's an element of fairness that has to be established. So that's what that means. Okay, so otherwise I've listed the chart has the majority of retirement plans, and you probably recognize which one you have. In the first column, we have traditional pension plans that are unusual anymore. Most of them are long gone. And if you happen to have one, then you're very fortunate because pension plans are generally paid by the plan sponsor as a monthly annuity payment to the retiree. They don't get rolled into IRAs, and therefore we won't discuss these retirement plans any further today. Also included in the chart are various plans that pay employees in company stock and stock options. If you have one of these plans, then you really need to seek individual help because the timing of option exercise and stock liquidation is highly individualized, and the tax consequences of a misstep can be pretty expensive. That being said, we will therefore limit our discussion today on 401ks, 403bs, and 457b plans, and they are the most prevalent type of plan in any regard. There are great similarities in these plans, but also a few important and unique characteristics that differentiate them. So I wanted to include a brief overview of each of these plans.
Rebecca, we have a question here.
Okay.
What's the difference between a non-qualified plan and a qualified plan?
A qualified plan has to meet all of the guidelines of ERISA, and a non-qualified does not. For example, in a non-qualified, you can have earlier vesting or later vesting. Usually with a qualified plan, you have to be there for 2 years. You have to be an employee for 2 years. You have to be 21 years old. And then, as mentioned, you have to have a specific number of percentage of participation of the workforce. And what that means just is that it has to be offered to to everybody. Whether people choose to participate or not is up to them. But if the employer has offered them that ability, then it counts. So stuff like that.
Thank you.
Sure. All right, so first we're going to talk about 401k plans. 401k plans are offered by for-profit, privately owned employers and are the most common type of defined contribution retirement plan. 401k plans are qualified plans, meaning they're fully subject to all the provisions of ERISA. Earnings on these plans can be tax advantaged if traditional 401k is selected, or after-tax contributions if Roth 401ks are chosen. And many plan sponsors are now offering Roth 401k options, but not all of them. Employees are given various investment options that have been pre-screened by the sponsor, and the individual account holder bears the investment performance risk. And this is a big reason for the disappearance of defined benefit plans, where the sponsor was responsible for paying retirees a fixed amount. That's what a fixed annuity is. It's a fixed amount of monthly payment, despite negative investment performance. So the plan sponsor was bearing the investment risk. So that's why most of them have switched to defined contributions now. The individual employee bears the investment risk. Investment options on these for 401ks can include annuities, mutual funds, or sometimes individual stocks and bonds. Withdrawals from traditional 401ks taken before the age 59 and a half can result in a 10% early withdrawal penalty, tax penalty, and then the amount of the distribution is fully taxable as income. There are exceptions for hardship withdrawals. Distributions for Roth accounts are tax-free if the requirements have been met. And there are basically two primary rules there. The first is that the account has to have been open for at least 5 years. The other is 59 and a half and over. Interestingly enough, the 5-year requirement also does apply for a Roth IRA. So, okay. Let's see.
I believe we just had a question come in.
Okay.
Go ahead. Do you have that, Michael?
Yeah, the question is, can you explain a Roth 401k versus a regular 401k?
Yes. A Roth 401k is the contributions are after tax. A traditional or tax deferred. So you're putting stuff in, you're putting money in without paying taxes on it. And that becomes very important after retirement, because if you're putting it in pre-tax, then the earnings, you have to pay taxes on them when you distribute the funds. A Roth IRA is a very, very favorable vehicle because the earnings are tax exempt. You pay taxes on the initial contribution, and then any earnings that you make through performance in the stock and bond markets are tax free. Okay, so now I'm moving on to the options. There are 3 options to manage 401k retirement assets post-retirement. In some cases, the plan sponsor allows you to simply leave the assets where they are. And this may be a very acceptable thing to do depending on the investment choices that are available to you, the plan expenses that you're being charged, and the investment performance. The second option is to take a direct distribution from your plan sponsor. And this means that they simply cut you a check for the amount of money that's in your account. And I should, at this point, divide this into 2 subgroups, the right way and the wrong way to do this. The right way to do this is to open a brokerage account, and when they cut you the check, just for example, if your IRA is going to be at Charles Schwab, you would have the check payable to Charles Schwab for and in behalf of your name. And if you do that, you're okay as long as you deposit that check within 60 days. The wrong way to do it is to have the check payable to you yourself individually. And if you do that, there are all these rules that you're going to stumble upon. And the IRS discourages this. So they make it very uncomfortable if you do this. The main reason people were doing this is because they were trying to borrow against those funds on a short-term basis. The problem with that is if they couldn't get money to take them out and they missed their 60-day deadline, then the whole thing, if you're under 59 and a half, is subject to a 10% penalty, and it's immediately subject to income tax. Furthermore, because the IRS is discouraging this, the plan sponsor you're leaving was required to hold back 20% of the account. And so just as an example, say I have a $100,000 account and I have them cut me a check. So it's given to me individually. I'm going to receive a check for $80,000. The $20,000 is required to be held by the plan sponsor. And then 60 days later, I need to deposit the money into an appropriate IRA. And if I don't deposit $100,000, even though I only got a check for 80, I'm going to be subject to tax penalties on the 20,000. So that'd be a $2,000 tax penalty. And I'm going to have to pay income tax on that. So you really don't want to do that. The third way, oh gosh, let's see, I'm having technical issues here. The third way to do this, of course, is the best way, which is simply to go down to your broker, open your IRA, get the account number, call your plan sponsor, give them the information. They'll probably have you fill out a little form, and you have them directly contribute that money to the brokerage account. And then you avoid any chance of a taxable event. So that's the way, probably the easiest and safest way to do it. I will say that most people, when they roll their money into a self-directed IRA, do choose an investment advisor. And IRAs have very, huge amount, numbers of investment choices. So it's appealing. Okay. Now I'm switching to
Rebecca?
Yeah.
Yeah, there's a question here. If I leave a plan assets in my 401k, how do I obtain investment advice?
Oh, well, on that, you probably have been getting quarterly statements all along from whoever's managing the money, and market outlooks and stuff like that. And usually the employer provides a phone number that you could call for investment information and investment advice. So you would just continue to do that.
Thank you.
Sure. Okay, 403Bs. All right, these plans are typically offered to employees of nonprofit entities and government workers, including public school employees. The plans were established in 1958 as tax-sheltered annuity plans. Originally, the plans only allowed for investment in annuity contracts with insurance companies, but they've since evolved and allow for mutual fund choices as well, depending on the sponsor. And these could be limited to variable annuity products with insurance companies. There are some 403Bs that allow for separate account management, similar to 401Ks, that allow pre-selected investment choices by the sponsor. While improving in recent years, generally the investment options are limited in these plans. And if that is the case in your plan, then you may choose to transfer your money to a self-directed IRA. Other noteworthy factors in a 403B would be that these are generally non-qualified plans, which means that many of the ERISA features may not be in place. There are two things, two special things about 403Bs that are actually better for employees versus a 401k, including immediate vesting is an option. And then they have what they call additional catch-up provisions. It's defined by the IRS. And it allows someone over 50 years old or older who's been with the same employer for 15 years to contribute an additional $3,000 a year for the last 5 years of employment. So that's appealing.
Sorry, I have a couple of questions here.
Okay.
All right. And it's regarding the previous slide.
Okay.
What if I don't have a brokerage account? Is it easy to set one up?
Oh, yes, it's very easy. You would just simply go to a broker and get a broker, get an application. These are usually only, a couple of pages long, take 5-10 minutes to fill it out. And then they give you an account number and they give you time to fund it because they know how these things work. The money's not going to get transferred right overnight. And then you take the account number and you fill out, short form with your employer or plan sponsor. And that's it. They direct, they roll the money over directly.
All right. And then there's another one. When one rolls the money into a self-directed IRA, does one keep the same old investments or must one select completely new ones?
You actually have the choice to do either. You can direct them to, hold all the old investments, or you can have them, direct them to sell everything and just roll the cash. So you have that option. There's usually a little box you could check on the application or on the instructions to the plan sponsor.
Thank you.
Okay, so I think we're on 403B rollovers, and historically, once someone left a 403B employer, the funds were retained by the plan sponsor. These rules have been loosened significantly, and now the distribution and rollover rules are similar to 401ks with the exact same warnings regarding anything other than a direct rollover. Okay. So 401B and 403B contribution limits. I put this slide in so that you could see the amount of savings that you can put into these accounts annually. And note that the IRS increased this amount to $20,500 for next year. Now for people over 50 years of age, there's what the IRS calls a catch-up, which is $6,500 both in 2021 and 2022. Making the amount that you can save up to $27,000 next year. And then, as I said, the 403B has that special catch-up feature, so you can contribute another $3,000 each year in the final 5 years in addition. So that'd be like $30,000 that you could actually save, which is really a nice thing to do. It's smart if you can. Okay, switching to 457B plans. 457B plan is generally offered by a state and local government, and it is always a non-qualified plan. The special feature in the government plans include that a plan sponsor can opt to provide both a 403B and a 457B to employees. And in this case, the maximum allowable amount of contribution has to be split between the two plans, but the same limits apply. So it's not like you can contribute $20,000 to one and $20,000 to the other. It's $20,500 for both. The thing that's great about this is if you haven't been able to make your catch-ups over age 50, and then in your last 3 years before normal retirement, you can actually contribute up to $39,000 over those 3 years if you have not used your full catch-up provision previously. Also note that in a 457B, the employers don't usually match contributions, and that's kind of why they chose to split because people wanted some wanted employer contribution. So that's why they would put money in a 403B. Okay, and then the other features about a 457. Lastly, the hardship withdrawals are very much harder to get than in the other plans. And they're only available if there's no other source of funds, no other source of funds. And the event has to be what the IRS defines as unforeseeable versus an emergency. So I'm not sure what that exactly means, but it's harder. And then the rollover rules are the same for a 401k. All right. I wanted to talk briefly about required minimum distributions, or RMDs. RMDs are a big deal and apply to all employer-sponsored retirement plans, including profit sharing, 401k, 403b, 457b, traditional IRAs, and IRA-based plans such as SEPs, which is a self-employment plan, and simple IRAs. And notably, they also apply to Roth 401ks. They do not apply to Roth IRAs. And there are exemptions for employees with less than 5% ownership in a company if they offer an employee-sponsored plan like a 401k, if they're still working after age 72, which is kind of nice. The rule for an RMD changed in 2019. If you reached age 70 and a half in 2019, the prior rule still applies, and you have to take your first required minimum distribution by April 1st, 2020, or I guess I should say you had to. If you reached 70 and a half in 2020 or later, then you must take your first RMD by April 1st of the year you turn 72. So it gives you an extra year or two, depending on when your birthday is. One exception for this is a 403B, where you made contributions pre-1987. And like the IRS in general, these are kind of arbitrary rules. You just have to know what they are. But if you made contributions to a 403B prior to 87, then you still have to take an RMD on those funds at age 70 and a half.
Rebecca?
Yep.
Sorry, I got a question here.
No problem.
Are there places on the internet where you can get distribution information? Yes.
You would calculate the amount of the RMD payable by looking at a life expectancy chart published by the IRS. It's Form 590B, distributions from IRAs, and you can either just go directly to the IRS website, or that's probably the best because you're going to have to do that for the table. You can get any kind of retirement income, retirement plan information by just Googling it on the web. And there's a wonderful source called Investopedia that gives general information. But on something with an RMD, since you need the table anyway, just go to the IRS, irs.gov.
Thank you.
Sure. So you go to the table, you find out what it's based on life expectancy. So they have a life expectancy chart that you would look at, and then you calculate the RMDs on each individual retirement account individually. But the amount you pay can all come from one account if you so wish. And then just importantly, you really do need to take that money. If you fail to take it, by the appropriate deadline in the appropriate year, the amount that you fail to take is taxed at a 50% tax rate. So it's important. And this chart simply demonstrates the amount of savings available to the contributor for each of the major retirement vehicles available in both 2021 and 2022. So as you can see, the first line there, 401k, 403b, the contribution limit is $20,500. That's also 457. If that's the only one you have, the catch up on that would put you at 27,000. And then the total contribution for the 401k, 403b, with the max would be $61,000, including your employer contribution. And I should tell you that there is a rule on that, and it's actually the lesser of 25% of your income, or $61,000. So to get $61,000, you'd have to have an income over $300,000. So most people don't get that much, but that's what's available. And you know, clearly a very, very valuable savings tool if you can take advantage of that. And that is it. I want to thank you so much for attending today, and we'll take any questions.
Yeah, we're going to open it up for questions now. I believe, Michael, we have a few questions already. And then if to our attendees, if you have a question, now is the time to type that in the chat. We will try to take some of them. And then, you know, if we don't get to it, go ahead and leave your phone number as well, because we'll reach out to you after today's event if we don't have the time to get it to everyone. Oh, Michael, I think you're on mute still.
Can you talk a little about the penalties of withdrawing from an IRA before retirement?
Yes. If you're under 59 and a half, there's a 10% penalty. So whatever you just, you know, whatever distribution you take, you have to pay 10% tax penalty on that. And then the, you know, if it's a pre-tax account, you have to pay income tax on that. If it's a Roth 401k, for example, if you take it before it's been open for 5 years, or if you're not, if you're under 59 and a half, you also have the 10% penalty, but it's not taxable because you put it in after tax. And I should just say there are exceptions to all of these rules for hardship, or you know, there are various exceptions. For example, in a Roth, if you were to lose your job, for example, and you have no other source of income, you can do what's called substantially equal payments. So you would go to the required minimum distribution table, you would see what your life expectancy is, and you would divide whatever your balance is by that number. And you would take that amount each year. And you have to take that much each year. And if you don't, there's a penalty on that. You know, you don't have to pay a 10% tax penalty in that event if you opt for that. The downside of that is if you get another job and you want to start contributing again, you cannot contribute to a Roth.
Okay, here's another question. If I have a Roth 401k that I've been contributing to, and I roll over the Roth IRA, does the 5-year rule begin then?
The 5-year rule begins when you start it only.
All right. And also, is there an income limit for contributing to a Roth IRA?
There is, and it's gone up. For a single person, it's about 200,000. For married, it's a little bit, it's more. But there is no limit for a Roth 401k.
All right. Another one is a self-directed IRA different from a traditional or Roth IRA?
It is the same as a traditional IRA, and a Roth IRA is basically the same thing. It's just you put the money in after tax.
Right.
And self-directed, meaning that you can choose all the investments yourself.
All right. Another question, what if I have maxed out my 401k at work? What might be a good vehicle for my next IRA?
Well, there are limits on what you can contribute pre-tax. So if you're maxing out, a lot of it depends on the type of employment you have, because there are rules on that too. But you know, savings is always a good idea, and you can save. And if you if you're over the income limits or if you've matched, then you'll save after tax.
Another question, what happens if my company goes out of business? What happens to my retirement account at that company?
There's an insurance, each plan sponsor has to contribute to an insurance plan by the government, and they have to meet funding requirements. And remember that with a contribution, defined contribution plan, you have an individual account that's funded. So that money is yours, and it's not really dependent on the employer staying in business or not. But there are insurance for contribution amounts in a specific year, but usually that's not a problem anymore because it's your money. For defined benefits, that was a big deal because the pension guarantee benefit corporation was a government established entity, and all these, I don't know if you remember, but many years ago there were airline bankruptcies, and they all had these defined pension benefit plans, and they filed Chapter 11 because their pension funds were underfunded, and the insurance with the government had to step up and make those people whole. But right after that is when you started seeing all these defined contributions because they just couldn't afford to keep doing it. So now you have your own separate account. If your employer goes bust, you still have your own separate account.
Well, I believe that's all the time we have for questions today. I want to thank both Michael and Rebecca for being here. What an informative discussion we've had, and really appreciate this information. I will say, as we're closing out, if people have more questions, go ahead and leave them in the chat, and I'm happy to save that data, and we will reach out to you to answer any more questions you have. On behalf of Advice Chaser, we want to thank you so much for attending. Look for an email soon for a link to the replay of this event. And we'd love some feedback in the chat if we've done a good job. We'd love to know if you appreciate this content as well. And please share with friends and family if they need this information as well. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.